Michael, good morning. I kind of want to start with the risk back on scenario because some of the names you've got in there, one in particular, I think is really interesting, and that's Atlassian, ticker team, software, product-led growth. Why isn't that and that growth story, without some of those overhead costs, why isn't that good no matter what the environment is? Have to do with valuations?
Yeah, I mean, it's primarily valuation first and foremost. Like product-led growth, we've said this is a difficult macro backdrop, but the fundamentals across software are as strong as ever, and the majority of stocks just aren't reflecting those fundamentals at these levels. You cited the IGV. Software is down 40% on average. We're below 5-year average multiples. So, the macro has weighed heavier on the Q4 earnings season than the fundamentals would reflect. But names like Atlassian are fantastically positioned from a secular standpoint. We like to focus on developers. They have always given profitable growth since their foundation. And we've said the leaders likely need to lead us out of this. Relative valuation is still clustered across software. So the platform names, the leaders, the Microsofts, the Workdays, the Salesforce, I think makes sense to show the initial strength. But after that, the mid-cap growth names have certainly more upside embedded into them, given what's reflected in the shares today.
Now, taking a peek at one of those more defensive names that you highlight, Intuit, which is interesting. Of course, we got tax season coming up in about a month, but also they've diversified increasingly, not just focus on small business, but also now more consumer with Credit Karma and other things. What do you view as being the benefit, the defensive benefit, even in a stock like that?
Yeah, the defensive benefits are, number one, U.S.-centric. So yes, MailChimp does bring them a more diversified international base, but a lot of the global conflicts and things we're looking at are taking place overseas. Intuit has historically been U.S.-centric. And then you do have the catalyst of tax season directly ahead of us. No question, there's just a demographic shift that's playing out favorably. Intuit has done a lot of smart things with TurboTax Live, the expert on-demand platform. We're seeing them leverage that across QuickBooks as well. So it's really a product story that's humming on all cylinders. And you're right, they're becoming more diversified. That being said, the tax season catalyst still ahead is attractive. And this is a different Intuit than we've seen previously. They're proving able to add some inorganic capabilities, still expand margin at a good clip. And we do think Credit Karma expands the consumer opportunity, and MailChimp similarly expands the small business opportunity beyond just accounting.
Michael, it's Deirdre. We often talk about the .com crash of 20 years ago. These days, one VC came on our air last week and said that this was, fully fledged .com crash 2.0. When you start to look at names to pick up, how do you know what's an Amazon and what's a Cisco, for an example? A lot of people point to Amazon. Yes, it continued to grow and grow after, but Cisco still hasn't actually regained those levels. It's still a great company, but the valuation just never, it's stuck. It's been a bit stuck. So how do you discern between tech companies?
Yeah, I mean, it's a good observation. It's difficult. We've certainly fielded the question just on why couldn't we stay lower for longer, or precursors of the .com bubble. I'll say a few things. First and foremost, software business models have changed a lot. So if you look back, there weren't a lot of large cap software companies at that point in time. It was not a recurring based business model. So you have a lot more predictability in these businesses than we've had before. There's obviously a continued secular shift. And the good news from a valuation backstop currently is we can start with the highest quality names. So I think we're looking for TAMs, we're looking for profitable growth, we're looking for management teams you can trust, ideally founder-led where applicable. And that's where the names that we're highlighting throughout this report come through. So Microsoft, Workday, Salesforce, in the large cap more defensive bucket, names like Atlassian, ZoomInfo, Confluent, and others in the mid cap bucket. You're never going to get all of them right, but I think at these levels, the risk reward is tilted much more favorably. And the benefits of software are significantly stronger here than we've ever seen, because I think SaaS is still deserving of a premium given that visibility that you get into the underlying business fundamentals.